Hello. Joining me today is Qian, Joint Portfolio Manager of the Baillie Gifford Positive Change Fund. Lee, thank you for your time.
Thank you, Carl. Great to be here today.
Fund performance has been exceptionally strong since launch. What would you say have been the main drivers behind the outperformance? Has your exposure to technology had a big bearing on that performance?
Yeah, so performance since inception indeed has been strong, but we will caution that even the 4-year track record is still a short time horizon for us. We think about the next 5, 10, 20 years. So although it's been a really promising start performance-wise, our focus is very much the long term over the next 5 to 10 years. In terms of what has happened from performance, we have been very pleased to see operational progress by many of the companies in the portfolio, which we think has indeed driven the outperformance across the portfolio. So example like Tesla being able to scale up the manufacturing of their electric vehicle, their more affordable Model 3 version, and prove that they can do it economically as well, has obviously led to a much higher share price today than when we invested in the company. Similarly, Dexcom and Moderna both have done very well, and that's on the back of fundamental progress they have made as a business in producing the coronavirus vaccine and scaling up continuous glucose monitoring devices. So we think that a lot of the outperformance have indeed been driven by the fundamental progress of the businesses that we have invested in. Of course, over a short-term period, there is market fluctuation due to a certain sector that comes in favor, a certain sector that goes out of favor. We don't really focus on that. Those in the short term can have a significant impact on share price and performance. But our focus is the next 5, 10 years. And we believe over that time horizon that what drive our performance is the fundamental operating progress. And that's what we keep our eyes on.
What's your view on the reflation trade, which has generated plenty of column inches of late? Is this something that concerns you at all, given you're focused on high-quality growth companies?
Yeah, indeed. I think it has taken up a lot of column space, this topic. We keep an eye on it. Inflation and discount rate does affect how the market values a particular company in terms of their future cash flow and how much they will discount that, and that have an impact on valuation. But once again, our focus is very much on the operating progress of the business. We are looking for companies where over a period of 5 to 10 years, if things go right, they could be a multiple of its current size. So in that context, even if inflation is higher and the market uses a higher discount rate, the fact that the size of the business will be a multiple of its current size means that the impact of inflation is likely to be reasonably small in terms of the ultimate valuation of the business. So once again, we do think about it, especially at a portfolio context, but our primary focus is the fundamental of the business, whether it has a long-term growth opportunity, whether it has a strong competitive advantage. And that's what we spend most of our time on.
In terms of recent portfolio activity, what have been the newest names to enter the portfolio?
Yeah, so we have taken 2 new holdings this year so far. One is a Canadian company called Abcelera. So Abcelera is a business that helped to improve the discovery of antibody therapeutics. So they have in-house technology that spans from how they immunize an animal to raise antibody candidates to how they then screen those antibodies to identify the ones that have the right potency for a drug and manufacturability as well, and then ultimately to how to develop that candidate further, and so that it can have the right drug-like characteristics. It is able to do that much faster than conventional method of antibody discovery. It's partnering with many businesses, large pharmas, small biotech, and even the likes of the Bill and Melinda Gates Foundation to accelerate development of antibody therapeutics. So that is a business we have invested in recently. And in fact, one of their antibodies that they have helped to develop has gone on to be used to treat for coronavirus as well. So it's already having a real world impact. The other company we have recently taken a holding is Peloton. And so it's a company that is providing connected fitness devices at a time when people can't go to the gym like they used to. Having the ability to exercise at home in a convenient way has a positive health impact, physically and potentially to mental health as well. Obviously, at the moment, its devices are quite expensive, but after meeting with the management team, they have articulated that there is a ambition to make connected devices much more affordable in the future, so that people across different income level can have access to the ability to exercise and being healthy at home, which obviously have a lot of benefits in terms of preventing chronic diseases.
The fund's size has grown rapidly, particularly over the last year. Does this make the fund harder to manage? And at some point, will there be a tipping point when the fund becomes too big?
So in terms of the fund size, we do have regular review of our liquidity and capacity constraints. And our most recent analysis has shown that with the current holding in the portfolio, their liquidity, how much they trade in the stock market, the fund can be scaled up to at least $15 billion without any constraint in terms of our ability to invest and access interesting opportunity. So we are still a long way off from that. So the size is not a constraint at the moment.
Lee, thank you very much for your time today.
Thank you, Kyle, as well. It's been very nice chatting to you.